Hello, this is Jim Ammerman, Managing Director at Fortress Wealth Management, and this lesson covers Roth conversion scenarios for those in the high tax brackets. I'm hearing concern from our high-income clients about taxes going up, and they're worried about future taxes that they will owe or their kids will owe on their pre-tax retirement accounts, such as traditional IRAs, traditional 401ks, SEP IRAs, simple IRAs, 457, 403B, cash balance pension, etc. And unfortunately, this is a valid concern. With $28 trillion in debt and counting, rates are going to probably be going up, and they're scheduled to go up anyway in 2026. One of the best ways to address this concern is a Roth conversion. It's a long-term decision with potentially large payoffs, and we are going to make a case that many investors, even those currently in the high tax brackets, might be well served to prepay taxes through the Roth conversion mechanism. We're going to assume that anyone considering this has enough cash to pay the tax on the conversion, or investments can be sold without generating too much additional tax liability. And that allows us to analyze paying these taxes as an investment decision. Simply put, what's the potential cash-on-cash payoff of doing a conversion? And like any investment decision, that answer is dependent upon some assumptions and projections. So to start, we're going to challenge the standard assumption that most high income and or older investors should not convert because they think they'll be in a lower bracket in retirement. That assumption is not a given, and there's at least three reasons why we believe that assumption can often be false. Number one, as I mentioned, the US is running a massive financial deficit, and both Social Security and Medicare are financially stressed. So a more aggressive means testing for both of them could be on the horizon with higher taxes. Number two, for investors with large pre-tax balances, the IRS required minimum distributions are large, which are going to push you up into higher brackets. And those alone might not be enough to cover spending needs, so additional withdrawals could push you into higher brackets. This is even more of a problem when one of the spouses passes away, and you're then subject to the single filer tax brackets. Number three, your taxable income level does not tell the whole story as to your true marginal tax rates. Other factors such as the Medicare premium tiers, the taxation of Social Security, capital gains tax, Medicare surtax, net investment income tax, QBI deductions, etc. Those all can increase your true tax rate. And many of these apply during your retirement years. But let's go ahead and look at a scenario where taxes do go down in the future. So here, we've got Ben on the left. It's 2021. We're looking at 25 years out when he's in his mid-70s. Currently, he's a California resident in the top bracket, so 37% federal plus state of 13.3%. Capital gains rate total is going to be 37%, looking at 23.8 plus the state. And let's say 25 years out in retirement, he's got a 10% drop in his rates. Let's also assume here in the blue section that he has at least $300,000 in pre-tax traditional IRA, 401k, etc. And $300,000 was determined to be the ideal amount to convert after some thorough, detailed analysis using e-money or some other high-quality software with CPA analysis. Let's also assume there's $151,000 in cash on the side, and that's being invested. Now, if that is not converted, we see down here going down after growing 7% per year over 25 years. We've got a nice total, but taxes are going to apply. Those could come in the form of RMDs if that's not pulled out all at once. And so we've consolidated all those required minimum distributions all in 1 year for simplicity's sake. And for the capital gains, we're looking at about $181,000 tax liability there. After tax, the net total is $1.6 million. Good job saving. But with the Roth conversion on the right in peach, still has the 300 growing to 1.62. It's the same investments. A Roth conversion is just relabeling a portion of a retirement account. It's not changing the investments. The cash is used to pay for the taxes on the conversion, so nothing there. And then when you look at the totals, he's got 18,000 more with this Roth conversion. Not much of an increase in the net worth 25 years out, but the important thing is we didn't do any harm. We didn't make things worse. And there was a 10% drop in his rates. So let's take a look at what happens if the rates stay the same in retirement. So 50.3 stays constant, 37 on long-term capital gains. Well, now we've got $250,000 of increase in net worth with the Roth conversion. And if rates go up in retirement, so we've got a 2.6% increase, which is scheduled to occur with the top bracket in 2026, might happen sooner. And a 5% increase on cap gains, which was thrown around here in 2021. Now we've got 300,000 plus of net worth increase. Let's take a look what happens if we grow this over 40 years. So now we're out to 2061. So maybe this is a scenario where it's somebody younger, where we're looking at, you know, the 80s or 90s as far as withdrawals being made. So we have the same increase that we just covered, and now we have $1 million of net worth increase. So 7 figures, not bad. And that's only on a 300,000 conversion. You know, if the ideal amount to convert is 600,000 or 900,000, then we're talking 2 million or 3 million. So the upside can be very significant with a careful Roth conversion analysis. Now, if you would like to ask some questions on this or the calculations, or if you want a free assessment on your particular situation to see if a Roth strategy might work for you, go ahead and shoot me an email at jim@fortress-wealth.com. And thank you for your time.